Good morning, everybody. Hopefully you had a good weekend, didn't get hit by all that weather. It's all over the country. So we'll go ahead and get started. If you have any questions, concerns, please shoot them at me. So the first thing I want to talk about is, there's been a lot of information about Greece in the on the national news, etc., and a little bit about China. But I want to talk about China. So it says Greece. This is out of The Street, which is a well, I'll get into it. Many of you know who The Street is. So, Greece is burning, but don't let the smoke billowing from Athens cloud your judgment as the state of affairs in China. As to the state of affairs in China, in many respects, the country that everyone thinks is still a white-hot. Sorry, I typed this in, so there's appears to be typos all over the place. A white-hot emerging market is on fire too. About 2.7 trillion in value has been destroyed since Chinese market peaked on June 12th, guys. $2.7 trillion, little or a lot of money. $2.7 trillion has been destroyed in the Chinese market just in the last month or so. So here's the thing. Since Chinese officials realized they went too far in trying to prevent overheated asset markets months ago, they have gone into scrambling to figure out how to govern effectively amid brutal market forces they've helped to create. Who knows if the bevy of measures like blocking IPOs will arrest the slide in risk in assets to China. Can I ask you guys a question? How much do you guys trust that our Federal Reserve, our government, our powers that be that manage the economy can do, are good at managing the economy in the United States? How many of you think? Everybody's saying lousy, haha, okay. How about Europe? Europe, London, how good are they? Okay, worse. So here's the thing. How long has the United States been doing that, and how long has Europe been doing that? How long have they been doing it? Yeah, a long time. How long has China been doing this? Do they know what the F they're doing? Or have they just been riding away? Guys, how could China was so backwards, how could they have done anything but blow up in a positive way like they have? I mean, when you're starting from ground zero with that many people and you're having your children manufacturing iPhones, I mean, is there any way that they shouldn't have blown up like they were after being behind for hundreds of years? Is there any? Did they have to even be any good, or did they just have to go from communism to opening up their markets to grow like they have? Or has it been because they're fantastic managers of the economy? I mean, why has China done so well? Because they're fantastic managers of the economy, or because they went from zero to, just opening? So now this is their first chance to see how they do when things get a little rough. And guess what? If I'm a betting man, guess what I'm not betting on? Because is it easy? Is it easy for anybody? Is it easy for anybody to manage the markets? It's not. And so now you have a bunch of communists who are trying to be capitalists. How's that going to go? So, I was talking about this, 2 years ago, about China being a problem, and I think we're starting to see it because so now we've seen the Chinese markets recover for the last few days. That means we're out of the problem area, right? Yeah, I agree with what Rick's saying. They're starting to learn what Japan learned. So this is oops, let me go here. And this is a chart of the day. So due to the fact Chinese stocks continue to plunge, today's chart this is from middle of last week, is an update from last week's chart on the Chinese market. It's measured by Shanghai Composite Index. With much of the world's attention been focused on Greece, it's worth keeping in mind that China is home to the world's second largest economy, and provides much of the world's economic growth. Investors are particularly concerned since the plunge in Chinese stock prices continues despite the fact that Chinese government has bought up shares of many large cap stocks. Guys, the Chinese government is trying to prop up the market by buying stocks. How is that going to end, guys? When the government jumps into the stock market and starts buying stocks to prop up the stock market, how is that going to end? They've stopped IPOs, cut trading fees, halted trading in many companies. Oh, great. Now they're cutting trading, I mean, dudes, and they're down 32% in less than 1 month. So how is this going to end? So it's something that we should be aware of, and if it does not end well, and again, see how the chart here in 2007 peaked? What's the difference between now and 2007? What's the difference between them crashing now and them crashing in 2007? First of all, we're all crashing in 2007, but what was the what's the difference? They were still going, Greg. So here's the thing: their economy was not even 8 years ago was not nearly the size of it as it is today. So if they get crushed today, guess what, guys? We're gonna feel it around the world. So I just want to make sure you guys were aware of that and have that in the front of your minds. Now I wanted to bring up something here. Last week's coaching call where I talked about the problems that I had. You know, what made me unsuccessful for the first 8 years in this business, where I was only making 50,000, and what I changed to go up to where I was making $1 million a year in just 3 years. I thought that was going to be a throw-off. You know, it allowed me to feel better about just venting about what you need to do to be successful. And I thought people would just say, yeah, Mike, yeah. But I had over 40 contacts from guys getting in contact with me saying that was the best call. It really hit them where it counts, and that, you know, it was changing the way they looked at their practice. Now 40, I mean, usually in a hot call, when I have a call, even though, you know, I'll have over well over 100 people on the call, getting 3 or 4 people to actually comment means it was a pretty good call. I've never in 15 years had over 40 people contact me after a coaching call. So if you're one of the guys that it really made sense to or really hit, here's what I would recommend. I would recommend every single day watching just 5 minutes of that video. So watching from 5 minutes to 10 minutes on one day, and then from 10 minutes to 15 minutes the next day, and 15 minutes to 20 minutes the next day, just to start out your day with a dose of am I approaching my business in a professional manner? Am I approaching my business by trying to get a little bit better? Am I trying to become a more professional or a more successful person on a daily basis? So just watching 5 minutes of that video would get your head on straight. Now, if you don't want to do that, here's what I did. Oh, 5 minutes of that 2% better coaching call from last Monday. But if you don't want to do that, what I did for years was I read a chapter out of Og Mandito's University of Success. So I actually wore out 3 copies of this book. I read it so many times. I mean, just fell disintegrated in my hands. Over 10 years, I wore out 3 copies because I read it every single day, just a little chapter, and each chapter can be read in about 10 minutes. And it gets your head on straight. Get your head on straight. So whether you want to watch 5 minutes of the call from last week, if you're a video type of person, or read a chapter out of this book if you're like to read instead. But every single day, start out. Now, why would that be a good idea to start out your day with 5-10 minutes of this, guys? I tell you, that's what I did before I became successful. For a decade, I did that. And in fact, I credit it with what? What do I credit it with? It took me 10 years of this stuff, but it finally worked. It finally worked. So I would highly recommend this, because you know how most guys, they'll what? They'll rush around the house, kiss their wife goodbye, walk into the office, and then just start working. And if you do that, what's the problem with that? Just walk in your office and start working. What's the problem with that? What's the problem with that? No focus, Casey. I'd agree with that. No focus, exactly, Paul. Casey, if you have no focus, you have no thing that you're going to be working on that day to get better at. Instead, you just wade your day, wade your way through the day. And that's, you know what, you can do that for decades and see no improvement. Have some focus with every single day. Does that make sense? Super. So I just wanted to do that. I've never had that kind of feedback from a call. So if it really hit you, please don't let it just kind of drift away. Actually make it part of your plan on a daily basis, okay? The Washington Post. Follow these principles and you'll be in much, much better shape than most Americans, or most anyone. And all it would cost you is $2.20 for a pack of index cards, and you'll have 99 of them left over. So what am I talking about here? Well, a professor at the University of Chicago actually wrote down what he thought people should do, or what he was going to actually do for himself when it comes to finances. He wrote it all down on an index card, and there's lots of this. If you Google it, there's a lot of talk on the internet about the fact that this guy encapsulates everything that people should be doing on an index card. And if people did this, everybody would be financially well off by the time they hit retirement. Now, University of Chicago, what do you think of when you think of the University of Chicago? I know there's one thing I think of. So what do you guys think of when you think of University of Chicago? I just want to give some credibility to this guy. So what do you think of when you think of University of Chicago? Great business school, Ivy League, medical university. Here are the people, the professors at the University of Chicago who have won the Nobel Prize for economic sciences. So is that small or big? That's a lot of people who are professors who have won the Nobel Prize for economics at one university. Can we agree on that? So the reason I point that out is this guy at the University of Chicago, is he an idiot, or does he have some weight to what he's saying? I would think that he'd have some weight. And here's what he said. Max out your 401k or equivalent employee contribution. Buy inexpensive, well-diversified mutual funds such as Vanguard, Target, 20XX funds. Never buy or sell an individual security. The person on the other side of that table knows more than you do about that stuff. Save 20% of your money. Pay your credit card balance in full every month. Maximize tax-advantaged savings vehicles like Roth, SEP, and 529 accounts. Pay attention to fees. Avoid actively managed funds. Make financial advisor commit to a fiduciary standard. Promote social insurance programs to help people when things go wrong. So if everybody in the country followed these pretty basic instructions, how well would people be doing? Now here's the unfortunate thing. Why don't we like these directions? I don't like these directions. Why do you not like these directions? Ah, Rick got it. Everybody's giving me all sorts of, Rick got it, Victoria got it. Yeah, Rick and Victoria got it. Yeah, Jeff got it. It means they don't need us. This is awesome. This is awesome advice. If people follow this, who do they not need? Us. So I want you to be aware, the 21-point checklist is what's saving your lunch, because the fact is, most people are saying this was good advice. Most advisors are going, good advice, good advice, good advice, whatever, but a couple of you guys recognize that if people follow this, they wouldn't need us. And yet if people followed it, they'd be extremely well off, wouldn't they? Very good. Jeff Dragon says, Harold Pollack, burn in hell. Yeah, it's Harold Pollack that said this. So the fact is, this is the best advice you can give people, but if you do that, you're not needed. So the fact that we have a 21-point checklist, the fact that we give value-added things, doing things we don't get paid for, is what allows us to actually feel good about getting paid to help people with their finances. But I thought I would show this to you, because this is the kind of information that our clients are getting every single day. So what books can you read to become a great investment advisor for your clients? Benjamin Graham, The Intelligent Investor, is what I consider the best book on investing. He's the father of financial analysis. He actually was a mentor to Warren Buffett, Munger, Bill Gross, and several other people. Winning the Loser's Game is another book that I think is an excellent book for you to read. Random Walk Down Wall Street, and Irrational Exuberance. Irrational Exuberance. So why do I like all of these books? Why do I like all of these books? Non-biased, right, Rick? Non-biased. Non-biased. That's why I like him. So Benjamin Graham was a British-born American economist, a professional investor. Graham is considered the father of value investing, an investment approach he began teaching Columbia University, Columbia Business School in 1928. See, he actually was managing accounts during the 29 stock market crash and the 1973-74 stock market crash. This guy has tons, or had before he died, tons of experience. Graham had many disciples in his lifetime, a number of whom went on to become successful. Most well-known disciples: Warren Buffett, William Rain, Irving Kahn, and Walter Schloss, among others. Buffett also, who credits Graham as grounding him with a sound intellectual investment framework, described him as the second most influential person in his life after his own father. In fact, Graham was such an overwhelming influence on his students that two of them, Buffett and Kahn, and you guys all know who Irving Kahn is, I hope you do, both named their sons after Graham. So that's the kind of influence he had on them. So this is a book. If you are making recommendations to clients, and you've never read this book, you are a hazard to your clients. This is just basic reading. This is 101. This is the beginning of your education. So if you want to be invested, if you are helping people on the equity side of the table, you had better be well versed in this book. Second one, Charles Ellis's The Winning the Loser's Game. In 1975, Charles Ellis published an article in the highly regarded by Financial Analyst Journal. So Financial Analyst Journal, kind of a pulpy, consumer-based, crappy journal, right? What would you consider Financial Analyst Journal? Pulpy, low end, low brow. Is that what we consider that journal? Or is this read by the brains in this industry? Highly technical, exactly. So that advanced the provocative proposition: investing is a game dominated by losers. Even though his central thesis was that investing is a loser's game, represents a profound challenge to accepted conventional investing thinking, his paper was recognized with the Graham and Dodd Award for Excellence. So what basically he talks about in Winning the Loser's Game is this, which I totally agree with. Winning the Loser's Game: the timeless strategies for successful investing is the fuller development of the reasoning and implication of his thesis. So this is this book was written, basically fleshed out the thesis that he wrote in Financial Analyst Journal. So it's indicative that as much as his legs is that over 500,000 copies of the previous 4 editions have been sold. So this has been issued 4 different times. The esteemed management guru Peter Drucker lauded it in an early edition, proclaiming this is by far the best book on investment policy and management. So guys, that's something worth reading, don't you think? And here's what he basically puts out there. This book was inspired by Dr. Simon Ramos's observation that tennis really involves 2 games. According to Dr. Ramos, winners of the winner's game, which involves a handful of professionals and very talented amateurs, most often prevail by making the winning shot. In the loser's game played by amateurs, outcomes are determined by the loser's mistakes. For most of the points in the games played by the non-pros are won by the player who does not make mistakes or makes the fewest amount of mistakes. Analogizing investing to tennis, Mr. Ellis avers that investing outcomes are determined not by the shrewd strategy and excellent execution of the winner. Rather, investing outcomes are determined more by the loser's mistakes than by the winner's proficiency. The key to winning the investing game, then, is not making mistakes. And the best way to not make mistakes is to not seek to score by shrewd strategy or superior technology. Instead, Mr. Ellis advises adapting a passive match-the-market strategy. So basically, let's see if somebody gets what he's saying here. Winning the loser's game, what do you think he's saying? Yeah, I'm getting lots of great answers here. So basically, here's the thing. Do you really think, I mean, when you, and in his book he talks about this, 54% of all the trades, or not 54, I think it's more than that, but we'll say 54% of all the trades in the marketplace are made by only 8 different entities. So those 8 different entities, do you think any one of them has an advantage over the other one? Do you think in these, these are the biggest companies in Wall Street. Do you think any one of them has advantage over the other ones? Who are they hiring? Yeah, they're all at the top of the heap, Gary. Exactly. They're all at the top of the heap. These are the best minds in finance, and they're using what kind of computers, guys? Who buys supercomputers? Who can afford to buy supercomputers? These companies. So they have the best minds. They're using supercomputers. So how can one of them get an advantage over the other? And if they do get an advantage, how long will that advantage last? So, and they are moving the bulk of the, if they can't get an advantage over each other, how can we get an advantage over them? See, that's the thing that we have to consider. So that's Ellis's whole point with the winning the loser's game. So Money Magazine, and the reason I want to bring this up is this is what your clients are reading. I mean, they don't read financial analysis journal. They read Money Magazine. So this was the primary article in their July magazine. The only two investment books you need to read. But guess what else? Guess the other book that they recommended. They said if you want to read something a little bit more technical, guess what book they recommended? Money Magazine. They said these are the only two books you need if you don't want to read something technical. But if you want to read something technical, guess which book you should read? And want to have a guess? The Intelligent Investor, the one I just talked about. So they were saying that's if you're and guys that have read the Intelligent Investor, it's not all that technical. It's really not that technical, but it's certainly more technical than maybe the average investor would want, unless they're a do-it-yourselfer. So the reason I want to talk about this article, the only two investment books you'll need to read, is because you need to know what your clients are thinking, what's being told. So everything we hear is an opinion, not a fact. Everything we see is a perspective, not the truth. So my opinion doesn't matter. Why don't you have to attend every argument? Why you have to attend every argument you're invited to? Or I'm sorry, why you don't have to attend every argument you're invited to. Guys, I just want to stress that what the books I'm about to cover and what they're covering is not my opinion. This is what I basically took this out of Money Magazine so that you have a better idea of what your clients are being fed by the more popular journals. Though I'm going to agree with most of this stuff. There's some things in here I don't agree with, but you should know what's being covered. So they said these are the two books you should read: A Random Walk Down Wall Street and Irrational Exuberance. Now, Random Walk Down Wall Street says don't fight the market, because they're saying, you know what, you're going to lose if you fight the market, because the market, almost like Charles Ellis was saying, is that it's too big, it's efficient, you can't beat the market, so don't try to beat the market because you will be crushed. Now on the other side, Irrational Exuberance, Shiller says that you can beat the market because sometimes the market gets out of whack. So basically what Money Magazine was saying is, listen, this is two different sides of the coin. So that even Money Magazine is saying, I don't know what's going to happen. I don't know which one of these is right. So you need to know both and then make an intelligent decision based on that. Random Walk Down Wall Street. I don't get what you're saying, John. Isn't Money Magazine an opinion? I don't get what that means, but maybe you can expound on that as I go through this. Random Walk Down Wall Street. So let's talk about that book first. Random Walk Down Wall Street says balanced, diversified portfolio, preferably using low index funds. That's what they recommend. Because basically he's saying stock prices are random. Stock prices are random. It's not that prices don't make sense. So hey, you know what? If a stock is undervalued, or if they have if they're undervalued and all of a sudden earnings comes out, what's going to happen to the stock price? If the stock is undervalued and earnings come out and they beat the market, or they beat what the experts say that they're going to make, what happens to the stock? It goes up. So it's not that prices don't make sense. There is some level of sense over time to what a stock does, right? If a company is more and more profitable, the stock eventually will what? Go up. But can I ask you a question, guys? Are there stocks that are, are there companies that are profitable, yet their stocks just stay in the cellar? Is that possible? Does that happen? I mean, think of Microsoft. Microsoft is one of the most profitable companies in the world, and it's just like a cash cow. But because they don't develop, they struggle with developing new things. Guess what? Does Wall Street like them or not like them? So it has nothing to do with how profitable they are. They're unbelievably profitable. They make more cash on a yearly basis than basically 99% of other companies' revenue. I mean, their profits are higher than most 99% of companies' revenues, yet they just linger in the bottom of the marketplace. So stock prices are random. Just because a company is profitable doesn't mean the price is going to go up. Also, are there companies that are not making any money whatsoever and their stock price is through the roof? Does that ever happen? A lot. So stock prices are random. It's not that the prices don't make sense. Can somebody explain, could somebody who's buying a stock that has not made any money, could somebody explain who's not a stock that hasn't made any money why they're still buying that stock? Can they explain that? I agree, Kevin. Emotion drives as a whole. Yeah, Tesla hype. Yeah. So, but could they explain if I'm buying a company like Tesla or a company that has made no profits whatsoever, can I explain to you why I'm buying it? When I go to my neighborhood parties, guess what I hear? All sorts of explanations from these quote-unquote experts on why they're buying these stocks, even though these companies they're buying have made no money. On the other hand, can somebody explain why they would not buy Microsoft? Even though it's a highly profitable company, can they explain why they wouldn't buy Microsoft? So everybody's got a reason, and does their story seem reasonable? It seems reasonable. So it's not that prices don't make sense. They totally make sense. But can you predict them? That's the thing. Just because the company's profitable, or just because the company's not profitable, does that have any idea, meaning, hey, it's got some bearing on whether the stock price is, but if you were a betting man, would you bet your house on it? No. I mean, I wouldn't. It'd be crazy. See, tomorrow's price might as well be random. What does he mean by that? Tomorrow's price might as well be random. Do we have any clue what any stock price is going to be tomorrow for any company or the market as a whole? They're random. Exactly. That's why the book is called A Random Walk Down Wall Street. We have no clue what's going to happen. See, markets, if we don't, though, have any clue, then he also makes the point that markets are efficient. So what do you think he means by markets are efficient? He says, if we could really find out based on price earnings ratio, based on cash flow, based on whatever, if we could really use information like that to know where a stock was headed. So, there's lots of information out there, right? There's tons of information out there, which is one of the reasons we have to be better at what we do, because is there more information out there available to investors or less information available to investors than there were just 10 years ago? Way more. Tons more. So we've got all sorts of information, and there's all sorts of systems out there where they're saying what? They're looking at all sorts of analysis with filters and everything else. So what do you think that this Random Walk says about all that information? With all the filters, all the different financial information you can get on stocks now, does that put you in a better position? Does that put you in a better position? No, and why doesn't it? He's saying it's great information. It's awesome information. He doesn't deny that, but guess what his problem with all that information is? And we talked about it earlier with those big 8. What's the problem with all that information? Casey's got it. Everybody has it. If that information is valid, I mean, other investors already have that information. They've already used it, which means the stock would already be where you think that those numbers are pointing. And in fact, these big 8 with all of the brain power, with all the supercomputers that they have, as somebody said earlier, they figured that out how quickly, guys. If there's a way for us to utilize all of that information to put ourselves in a better position, how quickly instantly, we're talking milliseconds. Do you realize they've moved their supercomputers as close as they can geographically to the center of Wall Street, so they get just a microsecond faster than somebody just maybe a half a mile away. They've gotten to that point. So if there was really a way to look at the numbers and have the numbers tell us what's going to happen, are you the only person? Now, it's different if you're the only person privy to that information. If you're the only privy to that information, then absolutely you can beat the market. But really, do you think you have more or less information than everybody else out there? And do you think any of the big 8, do you think they have more or less information or the same information that's available to everybody else? There is one way you can beat the market. What's that? It'll get you in jail, but you can beat the market. How can you do that? If you got more information than everybody else, yeah, insider trading. But that puts us in jail. Otherwise, if you don't have information that nobody else has, you've got the same information. So if you've discovered something in the numbers, believe me, guess what? If you've discovered something in the numbers, guess what? If you've discovered something in the numbers, guess what? I will guarantee you. What will I guarantee you? Somebody else has too, and before you or after you? Because are there people in this world, like I said, at the big 8, that all they do all day long is what? And they get the information how quickly? They get it before Morningstar gets it. They get it before Value Investing. They get it what? Instantaneously. So if there's really a way for us to look at the information and figure out which way the stock was going, if we believe that, then we also have to believe other people have looked at that, and that stock is already valued at what it should be valued at based on that information. So if we believe in that, then we can't get an edge on the market. So efficient market hypothesis says you got charts. Guess how much strength there is for efficient market with just charts? It's weak. Then you have news because that's public, that's emotionally driven. But as we talked earlier, the only way for you to beat the market is to what? Have private information, insider trading. And here's the joke about this. If an economist saw a bunch of $100 bills on the sidewalk, they wouldn't pick them up. Let's see if somebody knows this joke. If an economist saw a bunch of $100 bills on a sidewalk, an economist would not bend over to pick them up. Well, why is that? And it's a joke, but it's a teaching joke based on all the stuff we just talked about. Because he knows they're imaginary. How does he know that all the $100 bills on the sidewalk are imaginary? Because if they weren't, somebody else would have already bent down to pick them up. See, that's what we're talking about here. If really, if this information is, if these $100 bills are sitting on the sidewalk, all this information on how to beat the market, on how to invest better in the market, on how to find that secret stock that's going to make us tons of money, if that was sitting on the sidewalk, somebody would have already picked that up. Because those tidbits of information are going to last how long on the sidewalk? If they are really $100 bills to be picked up, how long would that information, with the supercomputers and the power that entities have now, and I would say seconds, I would say what, guys? Yeah, milliseconds. Does that make sense? So a random walk down Wall Street says that we all have two advantages, but possible one blind spot. The advantages are this: is be skeptical about paying high fees for active management. We don't want to hear that, but that's what, guys, how do we get around this with the 5Q system? Because you better believe that every single magazine, every single commentator, everybody's talking about what? And that's why robo-investors are what? Going crazy. And was I talking about robo-investors before it was on the front page everywhere, guys? I was talking about robo-investors a year ago. Now you're starting to see the other places talking about it, but I was already giving you the ability to overcome them even before anybody else was talking about them. And how do we overcome them? Somebody's already got it. Rick's got it. How do we overcome the robo-investors? The 21, exactly. See, we tell people that we're not, if we're charging them 1% management fee, we're not charging them 1% management fee. How much are we charging them? If they're paying 1% to us, how much of that fee is for our money management, guys? Rick already got it. Dino's gets it. See, get some other. 25 bips, exactly. Everybody's getting it. 25 bips. The other 0.75 is for the things we're doing in the 21 point checklist. If you're not providing value to your clients, you are a dinosaur and you are going to be dead sooner rather than later. I'll just be straight with you. Because every place they turn, they're being told what? Fees, 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 fiduciary, fiduciary, fiduciary. And the younger the investor is, the more they pay attention to that or the less they pay attention. See, we were lucky because our older investors, they didn't pay attention to that kind of stuff. They didn't have all the information available to them. But the younger the investment, and you know what, we have this new baby boomers coming up, and baby boomers are all about what? What are baby boomers all about? What are baby boomers all about? Me, 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 me. It's all about me. And if it's all about me, guess what? I don't want to give you what? If it's all about me, I don't want to give you what? Anything. And in our case, that would be fees. So beware that, this is the kind of stuff people are thinking. And does it have validity? It wouldn't stick if it didn't have validity in people's minds. So Money Magazine reports that 82% of actively managed funds have lagged the S&P 500 over the last 10 years. And what have we learned over the last year or so that I've been talking about this, about the 18% that do beat managed funds? What's the likelihood? What are they going to do over the next 10 years? In order for them to beat this, the 18% that beat the S&P 500 over the last 10 years, what are they going to do? Yeah, they're going to have problems because they had to take more risk than the market to do that. So the second advantage is it's impossible to get a trading edge. So if that's the case, just buy the index. That's his point. Now there is a problem with walking down random. It creates a blind spot as well. Because if we really believe in efficient market theory, it can blind you to risky market conditions. What does that mean? If we really believe, this is something that you could fight this argument with about efficient market theory. If we really believe in efficient market theory, it can blind us to risky market conditions. Why? Why would it blind us to risky market conditions? Yeah, bubbles, Michael. It's going to blind us to bubbles because if the market's efficient, could bubbles form, Michael? If the market's truly efficient, can bubbles form? No, they can't. But do they form? So as we see, this is a great indication of nobody knows what the heck's going on with the market. So a random walk down Wall Street says, hey, this is why you can't beat the market. Here's the market's efficient. But on the other hand, if the market's efficient, we would never have bubbles. So nobody has the answers, do they? See, there's so much information that goes on in the marketplace that's intellectual and also what? Not just intellectual, but what? Human runs market. Exactly, Gary. Humans run markets. Humans aren't efficient. There's so much emotional stuff that goes on with the market. So if the market goes up in fish way, why worry about prices going up? Because they never go up. They never form a bubble. So we have to understand that bubbles do form. So now let's talk about irrational exuberance by Schilling. Schilling won the Nobel Prize for Economics in 2013. He poo-poos orthodox versions of market theory. Prices don't move because of the numbers. They move because of psychology. So he's on the other end of the spectrum, right? So if prices move because of psychology, if you understand psychology, you can beat the market, right? That's pretty simple, isn't it? How many of us can guess what people are going to do going forward? And remember when we talked about what caused the flash crash? Then we went back to what caused the bubble in 2000, what caused the bubble in 2007. If people really knew that was the cause, what would they've all done? Would there have ever been bubbles? Would there have ever been a crash? If people knew that those were the reasons, people were going to was going to be the popping point for people to bail from the market. Because were those number reasons, guys, that the market crashed in 2007, 2008, that the market crashed in 2000, the market crashed in 73, 74, and 1987? Was it number reasons? Did somebody finally look at a number that came out on Monday morning and said, that's the number that's going to cause me to get out of the market? Is that what causes the market to go down? No, it's not. Because it was truly the numbers that have caused all those crashes. How long did those numbers exist? The numbers that caused, either it's easy for us to go look back now and say in 2007, 2008, we were buying all sorts of mortgages that weren't backed by, by any real hard asset. We were extending ourselves. In 2000, oh yeah, the technology stocks, boy, that was stupid. People were buying stocks that never made. 1987, 1973, 74. Those numbers always exist for years. So we never know. We never know what's going to cause that final pop. We don't know what's going to cause the market goes down, because the actual numbers, after the market goes down, everybody analyzes, whoa, yeah, these numbers are really bad. Blah, blah, blah. They were bad for years, but we didn't look at them as bad for years while they were going up. We looked at them as what? Oh, this time it's different. This time it's different. See, it's irrational behavior drives the marketplace. It's easy to see why what that irrational behavior is after the fact, but is it ever irrational while the market's going up? Do we ever look at when the tech bubble was going, when the tech stocks were going up, did we look at buying stocks with 150 PEs? Yeah, greed drives it up, exactly. So it's irrational behavior. So 2000 the tech stocks prices were exuberant. So if you'd really been paying attention to the numbers, you would have pulled out. But when would you have pulled out? In 2000? If you really believe that tech stocks prices were exuberant, would you pull out in 2000? No. When would you have pulled out? Believe me, in 1997, the stock prices were way exuberant. They just kept what? In 1997, they were blowing, the PEs were blowing everything out of the water. We'd never seen PEs like that before, but they kept going up, kept going up, kept going up, kept going up for 3 more years before it finally popped. 2005 real estate prices. Hey, did we all think, guys, did we all think that the real estate prices were exuberant? Or were the population, how many home equity loans were people taking out on their homes in 2007, 2006? How many people were buying real estate and doing flips in 2002? Hey, these are people who were supposedly knew what the hell was going on, and they were doing. So even we were fooled. The experts are fooled. So now we look back and say, oh yeah, well, how many of us and your clients were out getting home equity loans or flipping real estate during 2005, 2006, 2007? Yeah, Gary says you can run out of money before the market becomes rational. I totally agree with that. Today, bond prices are exuberant, or at least that's what Schilling says. So Schiller, here's his 2 bits. He says, a stock is worth the profits the company will earn for the stockholder. Duh, I mean, that's sane, right? That makes sense. That is rational. The problem is earnings jump from quarter to quarter. So what he says is you should average them out over a decade. If you do that, you can smooth out your numbers. So even he who says markets aren't efficient, is he timing the market? Yeah, I guess you could say he's timing the market. But would you say buying and holding a stock based on 10 years performance, is that timing the market? Or is that a smart way to invest? So even he's saying you can't time the market. Here's his lesson. When the price of the S&P 500 over the past decade is compared to the earnings, if its PE is higher, then you're going to see the average, which is 16. When the PE is higher than the average for the whole S&P 500, you're going to see on average lower returns over the next 10 years. Now, life is not exact science; it's an art, and this is what we just talked about. He says that over the next decade, if the PE, the average is 16, if the PE is over 16 for the entire S&P 500, over the next decade, the stocks will lag overall over the next decade. So it's not very useful as a timing tool, because here's the thing. PE hit 40 in 2000, but it was high for the previous 2 years. Schiller says today's PE 27 is relatively high as compared to the historic average of 16, but is that a prediction, guys? It's sort of, but when will that change? It's been that way for about 2 years now, so when will that change? Could it go on for another 2 years? So just because the PE is 27 doesn't mean it can't go up to 32. Heck, it went up to 40 in 2000. So it does not. That's the problem. We can't use this stuff for timing. We can certainly use it for a dose of reality, though, can't we? We're saying, you know what, we're significantly higher than the average. I should have some level of safety in my market, because are we ever going to be able to get out at the right time? Never, never, never. So the market could keep going for another 2 years, couldn't it? So what do we do? We understand that being overconfident is a problem. Being overconfident in our money manager, being overconfident in our own ability to predict. So how do we get over our overconfidence? We finally admit that what? I know nothing, in the words of Sergeant Schultz from Hogan's Heroes, I know nothing. If I know nothing, then what do? If I know nothing, if I admit, the smartest people in the world admit that they what? What do the smartest people in the world admit? If you ever met somebody who's unbelievably intelligent, I have a neighbor who's like that. He's off the charts intelligent, and he's the most soft-spoken person in the world, and he admits that he doesn't know anything. He admits he does not know anything, and he's smarter than me or any of the other people that I hang out with, but he admits he doesn't know anything. So if we don't know anything, what we want to do is hope for the best, prepare for the worst, and expect nothing. So what do I mean by expect nothing? What do I mean by expect nothing? Should I expect the market to go up next year? Should I expect it to go down next year? Or should I admit I have no clue what the market's going to do next year, tomorrow, next week, next month? I have nothing. So what I need to do is hope for the best, prepare for the worst. And how do we do that, guys? How do we do that? How does the 5Q system do that? Right, Victoria Insurance. So how do we have our portfolio set up generally for our people who are retired? 50-50, 50-50, 50-50, exactly. Now here's the thing. Safe doesn't mean low. As Jeff Van Grinsven and Jerry have showed us, over the last 15 years, how have our guaranteed investments, the 50% guaranteed portfolio, the 50% guaranteed portfolio in FIAs, how has that performed as compared to the S&P 500 over the last 15 years? It's better, very well. So just because you're getting guaranteed doesn't mean you're signing up for low returns, but we should expect low returns. That's why we have the guarantee. At least with FIAs, we shouldn't expect the next 15 years to beat the market like it has over the last 15. We should expect it to do what? Protect 50% of our clients' monies. That's the only thing we want it to do. Because again, what is our job? What is our job for our clients? What is our job for our clients? If we get them a 30% rate of return next year, how will that change their lives? Were they going to go buy the mansion they've always looked for? Are they going to go buy the Maserati they've always had their eye on? It won't change their lives at all. So our job is to make sure that they're living as well today as they were 10 years ago, and that they're going to be living as well 10 years from now as they are right now, with no blips. Guys, from 1998 to 2008, the market averaged a negative 1.4%. From 1998 to 2008, the market averaged a negative 1.4%. That means they weren't even keeping up with inflation. They were moving backwards. So people that retired in 1998, they had a very horrible retirement. Because here's the thing. When you're 60 years old, what's the difference between age 60 and age 70? What's the difference between age 60 and age 70? Little or a lot? What's the difference between age 65 and 75? No, it's not 10 years. What's the difference between 60 and 70? How strong? Oh, that's a joke. Thanks, Gary. So how likely are they to travel at age 60 versus 70, age 65 versus 75? How likely are they to be able to play with their grandkids at 65 versus 75? What happens to most people? Is that a little? I mean, the difference between 20 and 30, is that any different? 30 and 40, is that much different? 40 and 50, is that much different? But when you get into 60 and 70, that becomes what? The difference between 30, 40, 40, 50, that's not very big. But the difference between 60 and 70, that's huge. I know that because I'm getting to be that old. It's huge. So the last thing we want to say is hold on for another 10 years. Guys, should our clients be holding off on visiting Europe? Should they be holding off on visiting their grandkids because their accounts went down? Just hold on, cut your expenses so that when the market's recovering, you can start doing that stuff. Dudes, you can't do that. Not to these folks. Not to the folks that we work with. Not for retired. You can tell that to a 20-year-old, a 30-year-old, a 40-year-old, even a 50-year-old. You cannot tell that to somebody who's retired. Because 10 years from now, they could be what? Dead. They could be infirm. They could be less energy. They could be all sorts. That's a big difference. So we cannot be fiddling around with their retirement. We need to make sure now is not the time for them to get rich. Now is the time to make sure that whatever they've saved will maintain their lifestyle for the rest of their lives. Does that make sense to everybody? So what am I saying here? Am I saying that I don't like securities? Am I saying that I don't like active management? Am I saying anything about, all I'm saying is what? Just realize that with our equities, what do we know? That over time, they'll do well. But over time could mean how many years, guys? Even 10 years, from 1998, what did I tell you? 1998 to 2008, what did the market do? It lost 1.4% a year. So would you say that's doing well over 10 years? So now I will tell you that the market goes up 70% of the time. And that's why we need to be in equities. We need to have equities. But please don't promise your clients anything when it comes to equities. What should we promise our clients when it comes to equities? When the market goes up, what will happen? They will. And when the market goes down, what will happen? That's it. That's the only promise you should make to them. And you should say, over history, the market goes up what? 70% of the time. That's all we can promise them. And that's why we have 50% of our money in guaranteed. So I know we got into a lot of different things here, but is this every once in a while just helpful to talk investment theory like this every 6 weeks or so, guys? Got a few, yes, that's super. Good. Well, that's all I have, and I hope you have a fabulous week. Stay away from the storms and stay cool, and we'll talk to you all on Friday. Thanks, everybody.